Until recently, the oil and gas company Shell had the ambition to transform itself into one of the largest electricity producers in the world. The company reduced its oil production and began investing in renewable energy projects, such as a wind farm in the North Sea. Now, little of that ambition remains. Last June, CEO Wael Sawan said that Shell would relentlessly seek value for shareholders. The oil company will now focus on oil and gas instead of sustainable energy. Green projects will only receive support if they yield a return. The reason for the change in direction is Shell's lagging profits compared to other gas and oil producers. The British company had a price-earnings ratio of 5.02 in July, while Exxon and Chevron achieved ratios of 6.83 and 8.31 respectively. This irks Shell's board. These American oil companies have continued to focus on oil and gas, recently posting record profits. It remains to be seen whether Shell will continue to invest in sustainable energy sources. A few days ago, Bloomberg reported, citing insiders, that Shell is considering divesting its green activities. The oil company is exploring several options for the future, according to the news agency. The outcome of that investigation is not known. Shell declined to comment on the rumor. Shell's change in direction fits a pattern, according to research by CDP, an international non-profit organization that helps companies and governments report on their environmental impact, in collaboration with Sustainability Gauge World Benchmarking Alliance, which includes companies, NGOs, and research institutions. They conclude that since 2021, oil companies, including BP, ExxonMobil, and Saudi Aramco, have barely contributed to achieving the Paris Climate Agreement. Most companies do not publish figures on their investments in sustainable technologies. Those that do are spending far too little to help limit global warming to a maximum of 1.5 degrees Celsius, say the researchers. Investments in renewable energy yield much lower returns than oil and gas. That's the crux. Major players in the financial markets, such as pension funds and insurance companies, are still mandated to maximize returns, says sustainability advisor Harold Walkate, senior fellow at the Swiss Center for Sustainable Finance and Private Wealth. Unprofitable investments are hard to explain to shareholders. A sustainable strategy that doesn't hold water can make for a nice PR story, but investors will quickly see through it. For investors and retirees, the return ultimately counts, agrees ESG specialist Dima de Vries of asset manager Optimix. He focuses on social and environmentally responsible investing. Therefore, the government must take the first step for a successful energy transition. By increasing the CO2 price or offering subsidies for green activities, the government can make sustainable investing lucrative. As soon as it is profitable, money will naturally flow into green projects. Pressure from the market could lead to sustainability, says Vincent Trichin, head of ESG and sustainable investing at ABN AMRO. He has the mandate to look at the ecological footprint of business activities alongside the return. According to him, some investors are willing to accept lower profits if it means their investment contributes to a cleaner world. Shareholders can discuss the need for greening with a company's management. Then, based on reports, you can assess whether they are fulfilling their green promises. According to Trichin, the sale of shares of polluting companies by sustainable investors could also backfire. If oil stocks remain in the hands of investors who don't care about the climate, these companies will be less encouraged to invest in renewable projects. The transition from fossil fuels to renewable energy puts major oil companies on the spot. Should the billion-dollar companies make money from oil and gas for as long as possible and accept that this business activity is finite? Do they make the green turn only once green energy is profitable? Are the existing concerns the right parties to shape a sustainable future? Investors are expected to continue investing in fossil fuels until the business model gradually disappears, mainly due to government interventions, expects sustainability advisor Walkate. The economy still largely relies on oil and gas, as there is still good profit to be made in the coming years. The money that shareholders earn from this can be invested in renewable energy projects they have confidence in. Shell's consideration to divest its sustainable branch is not necessarily illogical, he believes. According to him, it is unrealistic to expect today's market leaders to implement sustainability in every sector. Shell is successful in oil and gas. Renewable energy, however, is a completely different activity, and specialized companies are much better at it, says Walkate. The history of innovation shows that few companies manage to successfully transform. It is more likely that other giants will emerge in the energy market due to the energy transition. Trishchin does believe that oil companies have a future after the energy transition, provided they become sustainable. Most shareholders want the company they have a stake in to still exist in 50 years and to be profitable at the same time. Investing is about ruling the future. The value of a share also depends on its future value, he says. So it's not so much a question of if, but when they want oil companies to invest money in green projects. Currently, it's not profitable enough, but as soon as it is, shareholders will naturally cheer. Oil companies also have no choice in view of impending laws and regulations on sustainability. Regardless of whether investors want oil companies to make the green turn, oil companies are essential for the energy transition, thinks asset manager De Vries. Major oil companies like Shell and Total have shown they can assess project efficiency well. This expertise is necessary for the energy transition. Oil companies also have a social responsibility to invest part of their billions in profits in renewable energy, says the ESG specialist. If Shell divests its green branch, it's highly doubtful whether the new company can raise enough capital to make the necessary investments, De Vries believes. Renewable energy companies have to make huge investments before they can make a profit. Under the wings of financially powerful companies like Shell, it is much easier to secure the financing of those investments. If this interested you, please subscribe to the channel.